Hello everyone, this is Ilya Spivak, currency strategist with Daily FX, and we'll be doing our outlook for the financial markets for the week ahead. Before we get started though, if everybody can type into the chat box next to the screen there, just give me a quick heads up, let me know if you can hear me, let me know if the video is coming through okay. Good, excellent, looks like we are in good shape. I want to start off actually with a trade setup that I just put on at the start of the week. There was, as most of you guys saw, a bearish break in euro dollar starting with the move just ahead of non-farm payrolls that we saw on Thursday last week. I didn't take the trade initially, not only because risk reward was shot, but because non-farm payrolls was obviously very close by. But it looks like the setup has given us another opportunity here. So here is the resistance level that I'm looking at. We traded up to that level right here and broke through this trend line support, which you can see if we zoom in right here. Okay, so this support taken out, we've bounced, and we're retesting basically this level now as resistance, reinforced by this larger line. The risk reward looks fairly acceptable. The stop is going to be a daily close above this wick high here at 33.44. The initial target, the 23.6 fib right here at 31.88. If we do the math here on the risk reward, I'll show you guys here essentially what I'm doing. So 33.44 minus 31.88 gives us 156 pips. If we divide that by 2, that gives us 78. And so if we add that to 31.88, that gives us the lowest possible entry that would be needed for a 1-to-1 risk reward ratio here, which would be 32.66, and we are just above that at 32.72. So we have about a 1-to-1 risk reward ratio here, slightly better. So I'm going to put on a small short here, and if we get a close underneath 31.88, I'll probably add to the position, obviously assuming risk reward is acceptable there as well, and then aim for 30.91, which is this next fib here. But at this point, that's a setup I've put on just at the start of the trading week. Now, let's talk a little bit about the outlook for the week here. We do have another interesting set of events that are going to be coming across, but very interestingly, the US calendar actually calms down quite a bit this week, and that is of course good news because there's a lot that we need to digest still from last week, and the focal point of the conversation, which of course is the taper of asset purchases from the Federal Reserve that is likely going to occur at the September policy meeting, is still an important consideration. But as we move away from essentially event risk that would inform the likelihood of that move, we now have arguably moved on into a conversation about not so much how likely it is, but what size. Because the Fed has been very specific about building out expectations for there being a taper in September. And I think as we move forward, the markets are going to increasingly start to speculate on the actual amount that the asset purchase effort is going to be reduced by. So the Fed is doing about 85 billion a month at this point. It's aiming for 85 billion a month. The loose consensus from essentially chatter on the news wires and around the markets is for a taper of about 20 billion to go down to about 65. Seems to be the sort of general mid-level consensus. Now, if this forecast begins to really solidify into something that is a sort of well-established consensus view, because I would argue it's still a little bit loose right now, but if it begins to really solidify into a baseline scenario, then a taper that's smaller than that might be US dollar negative even though the taper itself occurs. And I think as we look at US economic data over the coming week, we're going to start to see a dynamic where the markets still read US economic data that is stronger as being dollar supportive and US data that's weaker as US dollar negative. But the logic is going to be less so about the likelihood that better data will lead the Fed to reduce asset purchases, whereas worse data will lead it not to altogether. I think the conversation is going to be more so about how much of a taper is justified by better data versus worse data. And so, with that in mind, we look first and foremost at the ISM non-manufacturing composite figure that we have coming across later today. Expectations there for the index to rise from 52.2 in June to 53.1 in July. And of course, the service sector is the largest sector of the U.S. economy. So the pace of growth there accelerating would be a very helpful thing for the people betting on there being a relatively larger tapering effort in September. And so I think if we do get this number relatively strong, the U.S. dollar has scope to advance after we've seen this pullback recently. So here's the U.S. dollar index right here, and you can see we've taken out this resistance at 1080.20 or 10.820 here, and the next level up here 10.899, the 38.2 fib. We've recoiled off that, but we've not challenged this just yet, at least in a significant way, and it looks like it's held it up thus far as support in the sell-off in the aftermath of that soft NFP number on Friday. So if we begin to speculate more so about the size of the taper than about the likelihood of the taper, the US dollar ought to at least find some initial support as expectations for the size of the move begin to crystallize. In the very near term, as that transition in the conversation occurs, the US dollar seems likely to maintain relatively significant support. And so I would expect the US dollar to head higher from here, and certainly a relatively supportive outcome from ISM would help there. Now, looking out to the rest of the week, there is not really a whole lot of major high-profile U.S. data. We have the trade balance figure on Tuesday, which is not the biggest piece of event risk out there. We have the consumer credit number for June. That's coming up on Wednesday, and again, is not the biggest thing ever. And the focus toward the end of the week shifts essentially to jobless claims and what that tells us about the employment situation, because of course jobless claims were very, very encouraging last week, and if we continue to see support there, that actually bodes well, because the relationship between jobless claims and the S&P, which is essentially a gauge of overall risk sentiment, has been relatively significant over time. In fact, I'll post a chart later on the real-time news feed that I encourage you guys to take a look at. I just don't want to take the time here in our session to create it, but I'll put it on onto the real-time news feed a bit later, and you guys will be able to see it. There's actually a very, very strong inverse relationship over time between jobless claims and the S&P, and of course, with that in mind, it'll be interesting to see what implications that has for the dollar as a safe haven in the event that the S&P comes off, and see if the dollar actually finds some support, or if the numbers, depending on how they come out, are going to be treated more in terms of the taper, in which case a softer number is going to be relatively supportive for shares but detrimental for USD and vice versa. And by the way, if you haven't seen the real-time news feed, here is a link for that. Now, later on in the week, the situation essentially shifts to Fed commentary. And that's likely to be the real significant catalyst, given the absence of a large amount of critical data this week. And we essentially have three important speakers on the calendar. We have tomorrow the Fed's Fisher speaking on the outlook for the economy. The following day, we have Charlie Evans, the head of the Federal Reserve Bank of Chicago. He's going to be speaking, and very interestingly, he's not going to be speaking from prepared remarks, which means that he's going to be asked a lot of questions, and the taper is likely to be a very important point of conversation there. And finally, the following day after that, on Wednesday, we have the Fed's the Cleveland Fed President Sandra Pianalto speaking on monetary policy and the economic outlook as well. And although she will take questions from the audience, there won't be a press conference after that one. But the questions from the audience, again, likely to be very, very pointed at the Fed's decision to reduce asset purchases and sort of what shapes it and what kind of size we can expect. Outside of the U.S., there is a ton of event risk happening that is somewhat higher impact. In Australia, obviously the focus is on the RBA decision, which I will be covering live. And in fact, we're also going to be doing one of our Google Hangouts with my colleague John this week, another one of these macro pseudo debates that we've been holding, and we'll be talking about the outlook for the Australian dollar in our conversation this week. That's going to be happening on Wednesday, right after the RBA rate decision. But what we're looking for here, as I discussed in my weekly forecast for the Aussie, is an overwhelming likelihood of a cut being baked in already. In fact, the markets are looking at the probability of a cut at over 90%, which suggests that the cut itself is not likely to be particularly market moving. Now, if that is the case, then the spotlight is going to shift toward the statement that the RBA gives us and the amount of forward guidance on further easing that is contained therein. And if, of course, the RBA does not give us firm guidance on further easing, then we just might see the Aussie actually advance despite a rate cut. Because, as I mentioned, again, the cut itself seems to be in the price already. Now, if there is a degree of ambiguity, that of course shifts focus back to economic data. And with that in mind, we have the July jobs report in Australia coming up, with the economy expected to add 6,000 jobs there, down from 10.3 in June, and the unemployment rate expected to tick higher to 5.8%, which, of course, if that comes out, or if we get just a generally softer outcome, would increase the probability in the market's eye of another rate cut at the following RBA meeting, the one following the one this week. And if there is any ambiguity in the policy statement, then a data-dependent Aussie is likely to decline on something like that. We also have a wealth of Chinese data that's coming across the wires this week. The trade balance, CPI, industrial production, retail sales, all of these things are due as well. And given the market's responsiveness, interestingly enough, to both HSBC and official Chinese PMI numbers, interesting because the two diverged, where the HSBC number came in disappointing and the official number came in strong, and the Aussie responded in line, as one might expect, to both. It weakened on the HSBC number, it strengthened on the official number. So it would seem, overall, that given that speculative net shorts on the Aussie are still hovering near record lows, but the pace of increase has substantially declined, we're still in this space where if we get relatively supportive outcomes from China, even as the RBA doesn't give us guidance on further rate cuts despite a reduction this week, we may be looking at an Aussie dollar correction. And I'm actually watching how we behave here at the top of this former resistance, now recast as support at the top of this channel. If this ultimately ends up holding as support, we might actually reverse from here, and that would be something that I would look at as an opportunity to get short at a better rate. Now, thereafter, we have a set of GDP numbers from Italy, which will inform our outlook on the euro, and should be a relatively market-moving event if things are particularly negative, because if we recall from the conversation on ECB policy last week, what Mario Draghi has done is essentially refuse to give any kind of details, but say that rates will be low or lower for an extended period. Now, what that does is it effectively creates an easing bias, and again makes for a relatively data-sensitive kind of market, as the markets essentially attempt to figure out if the ECB is going to stay or cut. And if the GDP number is substantially disappointing, the expectation for the quarter over quarter is for a 0.4% decline after a 0.6% decline in the first quarter. If that disappoints, then we might just see the euro accelerate lower, as expectations for a relatively stable rate policy in the eurozone shifts to that second part of Draghi's forward guidance, which looks at the possibility that rates may actually be further cut. And so looking at Italian GDP for that, we have a number of other indicators relatively lower level from the Eurozone as well that are going to inform the outlook for growth. We have German industrial production coming up on Wednesday, the ECB monthly report, which ought to be interesting, but which arguably does not diverge too far from the monthly policy statement. But that's coming up on Thursday, and we'll be watching that for any notable updates in the economic outlook as well. Again, surrounding this idea that the ECB has left itself a window toward cuts. And the question now is when and if they'll utilize that window. Moving on to the British pound. Here we are. Here's a daily chart of the British pound. And looking at this, it was somewhat surprising that the BOE did not offer any kind of guidance and instead offered to just talk about guidance in the quarterly inflation report at the policy meeting last week. That quarterly inflation report, though, that's coming out this week. And the markets are going to be extremely focused on that. That's coming up on Wednesday. Markets are going to be very interested because, of course, what this is going to show us is what exactly the BOE is ready to do. Is it ready to tie monetary policy to certain economic outcomes like the Fed? Is it instead looking to give guidance that's more anchored in time, as the Fed used to do, saying it expects to keep rates low for X number of years? Exactly how this is going to look is going to be very interesting. And what I'm watching for here is the opportunity to get short sterling somewhere around here in this area, so just north of 153 or so, to see if this trend line here actually holds up and if there's an opportunity to enter short somewhere here following this reversal. All right, well, let's change gears here a little and take ourselves back to North America, where we actually have some notable event risk from Canada. On Friday, we have the employment report there, and in the absence of something like a commensurate big picture U.S. event risk, that might actually be notable. I'm looking at dollar CAD very closely. I was extremely tempted to get long last week, which would have been a wise idea in retrospect, but of course we don't know these kinds of things ahead of time. The idea was that the price broke out of this falling trend line here and then corrected lower to give us actually a fairly attractive risk reward, but of course this was non-farm payrolls, or at least non-farm payrolls was just ahead of this. And so as we got the pullback on the last day of July here, going into non-farm payrolls, we immediately had this rally higher. So as we confirmed here, the risk reward was gone, and then on non-farm payrolls, we pushed higher still. So looking at this going forward, the breakout looks good, but the risk reward is obviously not ideal still. So what I would like to see is perhaps a pullback down here to 103.56 or so to retest that 23.6 fib, maybe give us something like this consolidation here. So if we get down here or even lower, I would be looking for an opportunity to get long. As far as event risk goes, the focus singularly on the employment numbers on Friday, expectations there for the economy to add 6,000 jobs. That can, of course, be supportive in the sense that what you get from Canada is a better play on overall U.S. growth considering that, of course, Canada is a major exporter for the U.S., and if you get a recovery in the U.S. that warrants the taper and warrants these positive developments that the Fed has been talking about, then that's something that bodes well for the Canadian economy in terms of a pickup in U.S. demand, and bodes well for the Canadian dollar because it gives you an opportunity to trade U.S. growth without the headwinds from continued QE. Because although the taper is expected, the actual quantitative easing effort is of course going to remain at greater than zero for much longer. And in Canada, you don't have that at all. So, although the dollar might be well supported overall against the CAD, in the sense that a move to lower QE will necessarily lower the spread in bond yields, favoring the CAD, and move somewhat in favor of the dollar and likely send dollar CAD higher, there may be scope for the Canadian dollar to correct first before that happens. And so if we get a little bit of a pullback, then I would be keen to look for opportunities there. And finally, rounding out the week, on Thursday, we actually have the Bank of Japan rate decision, which I actually think is going to be a non-event. I don't think that the Bank of Japan is really in a place at this point where it's looking to do anything more on stimulus. I think at this stage the spotlight has essentially shifted, and what we're looking for now is what's going to happen on the fiscal policy side, the so-called third arrow of Abenomics, and we're not going to get details on that, arguably, until later into the fall. So for now, I think the BOJ is going to really give us nothing much in particular. But obviously, a rate decision is significant in general, and at least in the sense that it takes the attention of the market, and so that's something that I'm going to be watching closely. I'm looking at dollar yen pulling back here from this falling trend line resistance here, set from this high. You can see that's been holding fairly well here. And if we fib this on the assumption that this was the dominant move lower and this was the correction, then support, notable support, seems to be this fib here, the 38.2 level at 97.72. The 23.6 level, which you can see here, coming in around 99.74, but not as clean. And I would argue it seems to be holding instead here, rather than this 23.6 fib, is actually just these swing highs here. So if we were to essentially set up a horizontal line just right here off that low at 98.85, you can see that's been an important pivot here. From this low all the way over, you can see it's served as significant resistance here, came back as support here, and seems to be holding up again as support here, now that we've come off this line. So I'll be watching to see what happens here. If we come off this and break out, I would be, of course, very interested to get long. But in the meantime, I think that there is still a possibility for the dollar yen to come off this level as it becomes sort of increasingly clear that the BOJ is really not looking to do anything through year end at this point. Let's move on to your questions. Anant is asking, can you please explain the reasoning behind the short on Euro USD? Sure. So let's go back to Euro USD here again. I entered this short at 33, or I'm sorry, 32.70, and the idea here, from a fundamental perspective, is the shift in yields in favor of the US dollar. Now, we know from what the ECB and the FOMC told us last week, basically what the lay of the land is monetary policy wise, right? What we heard from the ECB is that the ECB will keep rates exceptionally low or lower. And what the president Mario Draghi attempted to get across, if you watched the press conference, and if you haven't, I would certainly suggest that you look that up. It's a very interesting press conference and very entertaining, I might add. But if you take a look at it, the message that he really attempted to send was that the ECB is not intent on abandoning an easing bias for some time. And if you look at the Fed, you necessarily have a, a contraction in the spread between EU and US bond yields, reflecting the shift in monetary policy, because clearly if the Fed is going to taper, that creates a divergence in what U.S. monetary policy is doing versus what ECB monetary policy is doing in favor of the dollar. And this is actually a chart that I've been updating for a couple weeks now. This is the latest update from sort of mid last week. You can see here how euro dollar, which is this red, or rather blue line, has been tracking the red line, which is the spread in the EU and US 2-year bond yields. So as you see, when bond yields narrow in favor of the US dollar, euro dollar comes down. So I would be watching this closely, and in as much as the outlook for monetary policy here seems to favor the dollar, I think that this sort of creates a bias to want to be short. Now, as far as actual positioning is concerned, we began to see validation of the timing as we took out this support here, and I'll make it a little bit better defined here so that you can see it. This was essentially outlining the trend, and as you can see, we've broken that. Initial risk reward was obviously not good because we broke down immediately into the support level, but the recovery here has actually allowed for the risk reward to be acceptable. And so with that, I got short. Dennis is asking, should we expect a return to 133 prior to the RBA rate cut? I can't imagine why you would necessarily expect that. I mean, 133 looks like a quote on euro dollar, which is not exactly something that you might look for in terms of a pair with big volatility potential on the RBA rate decision. You'd want to be looking at Aussie dollar for that. So I would not necessarily be thinking in terms of euro dollar as the pair I would trade the RBA rate decision on. In fact, I would not be trading the RBA rate decision in general. I'd be looking for what the RBA is going to say, looking at the volatility thereafter, and then sort of evaluating from there. Let's see. Which, by the way, goes right to this question here, saying, "Please tell me if the Aussie dollar is okay to long." Well, again, I don't think that we're ready to reverse here at this point, and certainly looking at the chart, it doesn't necessarily tell you anything that would suggest that a reversal is really in the cards. I think that the fundamental landscape, as I mentioned earlier, gives you space for that to happen, but I think that with that in mind, you have to wait for this to confirm. I don't see any reason to want to try to pick a bottom or jump the gun here. Teddy's asking for clarification at what price I got in short euro dollar. I actually got short right as we came on the session here, uh, and that was about 32.70. I believe 32.70 and a couple fractional pips. Let's see. Ribo is asking an excellent question. What happened to the fundamental Euro USD bull argument that the ECB is the only central bank reducing their balance sheet as part of LTRO? Well, the situation has clearly changed with the idea that the Fed is looking to taper its asset purchases. And surely, if the facts change, then we ought to be changing our perspective. We've seen euro dollar incidentally find quite a bit of upside on the LTRO idea. Obviously, the trajectory since March has favored euro dollar gains. But with that in mind, I think it would be foolish of us not to rethink this, given that the facts seem to have changed. Now, it also doesn't help that the recent paybacks of LTRO, if you've been watching them week to week, have been very, very small. By the way, those announcements usually happen during the European session on Fridays. We always post them up in the real-time news feed, so you can check those out there. But the fact that the Fed has moved to taper and the ECB has responded by adopting a forward guidance bias towards easing, which, by the way, the ECB has never done before and has been very much opposed to doing before, having effectively sort of adopted a position even before Mario Draghi was at the helm, that it never pre-commits on rates. I mean, clearly what the ECB has done here is pre-committed on rates in a somewhat softer way, perhaps, than some other central banks. But the fact that it has given fairly directionally biased guidance is also a game changer here. So the fundamentals have arguably shifted. Charles is asking, don't you think the euro dollar has fallen enough and the bulls are in control? I can't imagine why I would be thinking that, considering the euro has been rallying since the beginning of July. I don't think it. I think it's very tough to say it's fallen enough when it hasn't been falling, at least in the near term. And if we look at the outlook on the week, this is the weekly euro dollar chart here. The name of the game since the beginning of August, at least, but from roughly, let's say, late July of last year, has been upside. Right? We had a notable rally here from the low here in late July of last year, and arguably sort of we invalidated a bear bias here by late August. We invalidated the larger bear bias in sort of early December or so, and having made this high here, essentially around 137 40 or so, we've gone into what looks like consolidation mode. Now, you could make the argument that this is actually a symmetrical triangle here and that the next leg is higher this way. That's a possible argument. However, at the moment, it seems like the fundamentals have shifted and the overall picture favors dollar gains, as I just mentioned. But certainly the idea that the euro is oversold doesn't seem to have that much support behind it, because I don't see really how it could be oversold at this point, considering it hasn't been trading lower in a big way. Let's see. What else do we have here? Johan is asking to archive the webinar. I will absolutely do that, not only because I like to archive these things, but also because obviously we talked about the euro dollar short here, and as you guys know, I always like to post all my trades on the website for posterity, so we can always go back and say where I got in, and there's evidence of that. I want to make sure that we are keeping track. So since I don't have an article yet talking about the short, the archive of this very video is going to be the way that we keep score here on where I got in, for better or worse. Martha is asking, when is the next time you and John are going to have a joint session on Google Plus, and is mentioning that we do not have early notice of us doing it. As a matter of fact, you do have early notice, because John and I go out there and put a ton of Twitter notices, again, through the real-time news feed, which you guys can find here. And of course, if you guys follow John and myself on Twitter, you'll get those as well. But we put a ton of reminders here to essentially alert you guys to the idea that we're going to be holding these events. So definitely keep an eye on that. But I'll tell you right now that we're doing it on Wednesday at 23:30 GMT this week. So you have the answer on that you need already for this week. But going forward, you have a look at the real-time news feed, and that's going to be where we're going to be notifying you guys of that as well. Let's see what other questions we have here. Good one from one of our guests here, asking for the direction of the S&P. It's a nice segue for us, actually, before we call it a day here, to quickly take a look at the shares and commodities space, because we've obviously been very focused on X here in the initial part of the session. Here is the S&P, and as you can see here, we've put in a hanging man candlestick here right underneath the 100% fib expansion level of resistance at 1710.90. Very importantly, this hanging man is not necessarily bearish until it's confirmed. I want to stress here that what we're looking at is a indecision pattern, not necessarily a bearish pattern. So don't read too much into it, but potentially we do have an opportunity to perhaps see some S&P downside. We'll have to monitor how that plays out going forward. but something to watch here on the S&P. Looking at crude oil, we've retested this swing top here from mid-July, right around 108.80, 109, and we're pulling back here through this support at 106.50. We'll see if we get underneath it on a daily closing basis, in which case we'll expose 102.67 again, which is going to be this bottom here, where we got that bullish engulfing that sent the price higher. We'll have to see if this top holds, but something to keep in mind here. And on gold, we seem to have made the critical move lower. As we discussed for a while now, after we got this bearish engulfing here, we started to drift downward, and we finally taken out this channel bottom. So it looks like we're ready for extension to the downside. Initial support at 1274.92, so call it 1275. Resistance here at the channel at 1340, 1335, 1340, give or take. All right. With that, we'll call it a day here. I want to remind everybody that if you have any follow-up questions, the best way to ask those is, of course, through Twitter at Ilya Spivak. If you would like to sign up for my email distribution list to receive my articles directly, that is very easily done. I'll give you guys a link where you can do it in just a moment here. Let me just pull this up for you. And I just want to remind you guys, because this seems to be a persistent point of confusion, you're going to get a confirmation email once you sign up. It's very important that you click the link in that email. Don't actually reply to the email, because it just goes to an automated email system and doesn't actually sign you up. Just make sure you click the link in that email, and that'll actually complete the setup for you. So that's the link for that. Thank you everybody for joining me. I'll be back for the RBA rate decision, and the way that we're going to do it this time is we're going to do a little bit of a pre-event strategy session on regular daily FX, and then switch to daily FX Plus for the actual announcement. So those of you that have access to both, I would encourage you to join the session on regular daily FX as well. That way we get as much covered as we can. Thanks everyone, and I'll speak to you guys first thing on Wednesday when we get ready for this RBA announcement. In the meantime, good luck out there and take care.